Today, I want to cover some of the most common trading maxims or sayings or general truths that you will often hear in trading circles. And the reason I want to discuss these trading maxims is sometimes people, especially new traders, will hear these maxims and they will misinterpret them, or they will interpret them to actually mean the opposite of what they truly mean. And the first maxim is, when everyone rushes to one side of the boat, head to the other side to avoid getting soaked. So this particular maxim obviously is a warning against being a conformist. It is actually telling you you need to be a contrarian, because most traders lose money. Because most traders lose money, don't do what most traders do. If everyone is buying, you should be selling. If everyone is selling, you should be buying. If everyone is running left, you need to be going right. The next maxim is more than just a trading and investing maxim. It's a maxim for general finance. It's really a maxim for life in general. And that is, don't put all your eggs in one basket. You've probably heard that a million times. What does that mean? Well, in trading, what this means is be diversified. Don't put all your eggs in one basket means don't trade just one underlying stock. Don't trade just one strategy. Be diversified. Trade multiple underlyings. Trade multiple strategies, trade multiple directional assumptions, have some bullish trades on, have some bearish trades on, trade multiple time frames. As an options trader, we get to choose, our DTE, our days to expiration. Don't trade everything in the same cycles, stagger things. That way you have some options that expire this week, some options that expire next week. And the more you diversify, the less likely that some outlier event is going to cripple your account. And because the outlier events can and will happen, just make sure that you diversify a little bit. Also, don't put all your eggs in one basket. When we're talking about just general life, just general finance especially, don't have one stream of income. Most people have only one stream of income. They work a job. That's the only income they bring in. Have some side hustles. Have a few different side hustles. Have some passive investing. Have an IRA account, a retirement account. Have some shares of SPY sitting around. Have something working for you other than that job. Next up is the trading maxim we've all heard a million times, and that is buy low, sell high. Now, this really tells us how to make money here in trading, right? You buy things when the price is low, and then you sell it when the price is high, and you profit from that price difference. This could also be written as sell high, buy low. You could actually do it in the reverse order. For example, if you're shorting stock or shorting options, when we sell options, why do we sell options? We typically sell options when IVR is high because those premiums are high. We sell options when they're expensive, and we buy them back when they're cheaper, and we profit from the difference, right? So it's not just buy low, sell high. You can also do it in reverse. Sell high, buy low. Next is players on the bench get the lowest pay. Now, what this is a warning to all of those traders that sometimes pull themselves out of the game. Many traders do this, and it is a complete and total mistake. What they'll do is, when there's a crash or when there's a recession, when there's any kind of volatile period in the market, they'll just pull themselves completely out of the market, right? They'll close all their stock positions and they'll just sit on cash. They'll just sit on the sidelines, right? And again, players on the bench get the lowest pay. Yeah, you're not losing money when you're just sitting on the sidelines and when you're not actually playing the game, but guess what? You're not making any money either. And when the most opportunity is available in the market, it's actually in those high volatility times. It's right after that crash, or it's in the middle of that recession, right? That is when there is the most opportunity to make money. So again, players on the bench, you're going to get the lowest pay. And next is a warning. Don't fall in love with your positions. So veteran traders will often tell newer traders this warning: don't fall in love with your positions. And the reason we always tell novice traders this is because this is one of the most dangerous things you can do. So you have an assumption. You make an assumption and you decide to put on a trade that fits your assumption. So if you're bullish, you're going to get long in something, or if you're bearish, you're going to get short in something. You had some assumption, you made a trade. But then, for whatever reason, things don't work out. The market turns. All of a sudden, conditions change. But you're afraid to give up on that dream because you put on that position because you thought it was going to be the best position ever and you were going to make a ton of money. And when things don't work out, sometimes people will just hold and hope, right? You refuse to close that position. So what do? Well, your position becomes a small loser. But you hold on. Then that small loser becomes a big loser. And you still hold on because you don't want to give up that dream. And then that big loser becomes a monster loser. and then you blow up your account, right? So never fall in love with your positions. And the next maxim is really a financial disclaimer. This is the general financial disclaimer that you've heard thousands and thousands of times. Past performance does not guarantee future results. So what does this mean? It means exactly what that means. This is the standard mutual fund disclaimer is, hey, whatever we did in the past, we may have made money, but that doesn't mean that when you put money in our fund, we're going to make money next year, right? Basically, it's just a way for funds, especially, to just cover their ass, right? So anytime you buy into a mutual fund or ETF or whatever it happens to be, you know, they just want to put that out there. Hey, we've been profitable before. That's probably why you're looking at us, but, you know, nothing is guaranteed. The future is never guaranteed. And in some ways, this is efficient market theory, right? The future cannot be predicted, right? There is no one that can accurately and reliably predict the future. So again, past performance does not guarantee future results. Next up is trading is a marathon, not a sprint. And this is one of the hardest things for new traders to understand. Trading is a marathon, not a sprint. This means that you should not be trying to hit the home run. You should try to hit singles, right? It's not about making the big plays. It's about making thousands and thousands and thousands of small plays over many years. It's a marathon. It's not a sprint. You're not trying to make that $1 million overnight. At least you shouldn't be, because if you're trying to do that, it means you are taking way too much risk, and you're much more likely to actually lose all of your money than actually make that amount of money, that $1 million or whatever it is that you have in your head that you're trying to make. You're much more likely to go broke than make that money if you're trying to sprint to it. But if it's slow and steady wins the race, right? If you're doing the marathon approach to this, then you will almost certainly get to that dollar amount you have in your head, given enough time. Next up is, it's okay to be wrong. It's not okay to stay wrong. So obviously this is very similar to the earlier maxim about don't fall in love with your positions. This is very similar. It's okay to be wrong. It's not okay to stay wrong. You're going to occasionally make assumptions. You're going to have some kind of intuition, some kind of instinct where you think this trade is just going to be the greatest trade ever, and you put it on, but then things just don't work out the way you expected at all. You were wrong. It's okay to be wrong. You're going to be wrong. You're going to be wrong a lot in trading. What's not okay though, it's not okay to stay wrong. Once it's obvious you're wrong, get out of the damn trade. And the final maxim for today's video is, bulls make money, bears make money, hogs get slaughtered. So obviously this is a warning about being too greedy, being too aggressive, being too excessive in your trading, taking on way too much risk, because, you know, being a profitable trader is not about picking direction typically. That's why this saying is, bulls make money, bears make money, but the hogs get slaughtered, right? You can be a perma bull and make money. You can be a perma bear and make money as long as you don't risk too much, as long as you keep your risk in check. But the minute you get greedy and you take on too much risk, when you become a hog or a pig, right? You're trying to be greedy. That's when you get slaughtered. Another variation of this maxim is that pigs get fed, hogs get slaughtered. Now, if you want to learn more about options trading, and especially my favorite option strategy, which is the wheel option strategy, check out my book, The Super Wheel Option Strategy, available on Amazon. You'll find a link to this book in the description below. Also, in my book, The Super Wheel Option Strategy, I actually have a chapter on popular trading maxims, very similar to what I discussed today on this video. So if you like this kind of video content, check out my book. Peace, guys.